This is FinTech Insider News. This week, the huge nationwide Virgin Money deal is done. So what does it mean for the future of banking in the UK? Visa is being sued by the Department of Justice as the Biden administration continues its crackdown on junk fees. And as this week marks World Mental Health Day, we'll be discussing how to cope at work. We'll be discussing all of this and more on today's show, so don't go anywhere.
Ready to launch a career and future you can be proud of? Welcome to Merrill, where an industry-leading advisor training program will help you get licensed. And with lead gen support from Bank of America's vast customer base, you'll get the referrals you need to establish your own practice. It's time to see your career charge forward with Merrill. Apply now at careers.bankofamerica.com. Copyright 2024 Bank of America Corporation.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
Hello and welcome to episode 903 of FinTech Insider. I'm Laura Watkins, Director of Media and Marketing at 11FS. I'm joined this week on FinTech Insider News by some great guests who are here to break down the biggest stories from the past week in fintech and financial services. First up, we have my co-host for today and fellow 11, Dave Morris, Global Head of Technology at 11FS. And it's great to have you on the pod with me, Dave. We haven't done one of these together before.
No, we haven't. No, it's first for us. Yep.
And without giving anything away, can you tell the listeners about anything that you've been working on recently?
Yeah, it's busy at the moment. It's our sort of going into Q4, so doing a lot of planning and things. So yeah, it's going to be a good end to the year with lots of things that we're working through between now and the end of the year. So exciting times.
Excellent. Amazing things are coming. So, and up next, a FinTech Insider debut for Alberto Dalmasso, CEO and founder of Satispay. Welcome to the podcast, Alberto. Can you tell us a little bit about yourself and Satispay?
Great to be here. I'm a CEO and co-founder of Satispay that I founded back in 2013. Satispay is the leading mobile payment solution in Italy. It's the local payment network alternative to debit and credit cards that is helping Italy digitalize its payment. While it used to be kind of a cash society 10 years ago, now is more than 50% of volume are electronic payment, and we are part of that. And then we're also engage in helping our user to save money and helping corporate issuing employers benefit, all part of our payment network.
Amazing. Well, thanks for joining us. And we look forward to digging into your payments expertise with many of the stories on today's show. And last but not least is a warm welcome back to FinTech Insider for Jessica Cath, partner financial crime at Thistle Initiatives. It's great to have you back on the podcast. How are you, and what have you and the team at Thistle been working on lately?
It's wonderful to be back. We've had such a busy week and a busy day, to be honest, and we'll be talking a lot about the fines at the moment. But we're doing a lot in fraud, which with the APP fraud, we're doing a lot in sanctions with different tools and testing, and we're doing a lot of remediation work, which I think we're going to cover a lot today.
Yeah, all super relevant to today's conversation. So let's jump straight in. So our first story this week, Nationwide completes the Virgin Money takeover to create a high street banking titan. This story was in City AM and many other places. The £2.9 billion acquisition marks the UK's biggest banking merger since the financial crisis. The deal positions Nationwide as the second largest provider of mortgages and savings in the UK and marks its entry into the riskier business banking sector. The merger, approved by UK competition regulators and supported by 89% of Virgin Money shareholders, is part of a wave of consolidation in the UK's mid-sized banking sector. Coventry Building Society is also set to acquire the Co-op, and Barclays has recently purchased most of Tesco Bank. While Virgin Money will continue to operate as a separate legal entity in the short term, it is expected to fully rebrand within 2 years under Nationwide's ownership. So the deal has been done. What are everyone's immediate thoughts? Dave, maybe you can kick us off.
Yeah, I think it's interesting for Nationwide. I think it's a great deal for Virgin, and particularly Richard Branson, I think, has done quite well out the back of it from what I understand. But I think Nationwide have been struggling as number two for a long time, never really grown their mortgage market. They were sort of at that sort of static 12-ish% of the mortgage market, and not really getting anywhere near Lloyds Banking Group's big numbers, which obviously a lot of that grew through the end of the sort of financial crisis and the merge of that big group of organisations into that group that they are now. But this really, I think Virgin are number 7 from a mortgage perspective in the UK. So it's two big banks coming together, which gets them very, very close to Lloyds Banking Group from a sort of percentage of the mortgage market. So I think it's going to let them really compete in that space. And obviously the other big gap, and the big thing that it brings, Virgin have very, very strong SME brand from a banking perspective, which Nationwide have never really played deep in that space. So I think it's a good move for them to sort of get into that space as well.
And just bringing you into this from that sort of regulatory landscape with your kind of fin crime and regulation hat on, what do you think this means for the kind of UK landscape?
I think for me, it's really, really interesting because it's more about the cultural change between the two banks and what that actually means for the customers. And when you're looking at it from a kind of financial crime and compliance lens, customers, when they're dealing with Virgin Money, are going to have a very different experience to when they're dealing with Nationwide. So when you're kind of bringing these two together, it's what is the customer going to get? What are the control frameworks going to look like? And how do you manage those competing cultures and bring those control frameworks together to make sure they're actually managing risk? And then from my perspective as well, it's slightly off topic, but nobody's really covering this at the moment. But when firms go through this kind of deal or merger or change, this is a primary focus area for customers to be targeted for scams. So fraudsters do look at customers during this period of integration and target them for, communications from perhaps Nationwide if they're an existing Virgin Money customer for different fraudulent things. So with my financial crime hat on, be aware of potential scams. But for me, it's looking at what is going to be the consumer impact and also how are they going to start pulling their control frameworks together to ensure that they're compliant.
That's really interesting about the scam. It makes total sense when you say it, but it wasn't something I'd really thought of before, and it hasn't really been reported on either. But Alberto, you were nodding as Jess was saying that. What's kind of your thoughts on these kind of big high street bank mergers?
Well, I think if it comes out as a good integration, it's only positive for the competition that is going to come to the market. And I think it's an healthy consolidation. I have a lot of question mark on the two very different cultures, as Jess was saying, bringing them together. I think all the heavy lifting, all the hard work will come now. Because if they can pull together something like Virgin Money user experience for everybody, maybe better customer service, more closer to the consumer, kind of a user-first approach that typically Virgin brings along with a bigger size and all the SME market, which is kind of much easier to get on board with new clients. The funnel of acquisition is much shorter. It's a great deal. But that looks to me as an entrepreneur looking at the culture of my company, caring about that. I'm always super scared about even looking to acquire anyone because of the clash that can happen. And that's the big challenge. And if they can turn that around and make the two groups work well together, the market and at the end the consumer are going to benefit, because it looks like Lloyds is quite dominant at the moment, and having another similar force, it's always super positive.
Yeah,
I think people always talk about the culture thing when two banks merge, but this is sort of culture on steroids, because it's a mutual and a traditional bank view of the world, which
two different animals,
and very different animals, and Nationwide have a very unique culture, on the way they operate, the way they think about their customers, because of that mutual nature of them and their sort of, built-in, finance for good view of the world that they work towards. So I think that's going to be an interesting integration part for them.
Yeah, that culture point is super important, and I think that's always a concern with mergers. But as you say, like balancing that kind of mutual sort of behavior, that kind of building society versus the Virgin Money brand, and then equally kind of bringing the shareholders along for the ride as well is definitely a challenge. What do you think to that, Jess? We sort of read at the top that 89% of the shareholders approved this. Obviously, that's a majority, but what about the dissenting 11?
I mean, from my perspective, I do think that the integration is going to be a very, very big challenge. Again, coming at this from the financial crime compliance perspective, when you have a mutuality versus profit-driven entrepreneurial company, you have very, very different control frameworks and ways of doing things. You have different team sets, you have different tooling, you have different processes and procedures, you have different speeds, different mindsets. So bringing this all together is going to be very, very challenging. But all of that requires top-down approval in order to make all of those changes. So I think taking everyone along the journey to make sure that the customer still gets the best experience and you remain compliant is going to be the challenge.
Yeah, I think it's billed as a merger, but it's nationwide taking over. The 89% is the shareholders on the Virgin side, and that's very much it's a good purchase for me. I'll get a good chunk of money back on that as a shareholder. It didn't need to go to the members on the nationwide side, which is interesting. So within their regulations, they didn't need to go for a vote.
Interesting.
So it'll be interesting to see whether there is any dissent within the membership on that side. Interesting.
And then, as you say, kind of it's billed as a merger, but it's sort of much more of an acquisition. And sort of with my kind of marketing hat on, I'm kind of interested in the kind of lifespan of the brand. So when we first reported on this earlier in the year, we speculated on whether or not Nationwide would keep the Virgin Money brand separately and use that to their advantage. But actually now we know that they're going to fold everything under Nationwide. Is that a sensible move? What do we think Virgin Money customers will think about that? Alberto, any thoughts on that?
This is, kind of the point I was trying to make on keeping some of the Virgin Money culture, because I think they are the one being acquired. I think the mutual approach of Nationwide is great for the customer, but I think there's value in the performance-driven culture of Virgin Money. But if already we think about the brand disappearing, I think that's going to probably have an impact on everybody working in Virgin Money. And my suspect is that maybe they cannot influence that much the overall culture of the new group. While it would be great, I believe, if the good of that more entrepreneurial approach and market and performance-driven approach can also come into Nationwide by preserving the nature of a mutual business, but not even already declaring that the brand is not gonna be around. I will have communicated it later.
Oh, really? Okay. So you think they went too early with saying this?
They were not maybe thinking about the people working there, or maybe they've done all their analysis, but we have to think that people working in Virgin Money at the moment are maybe slightly scared, and they don't need to be thinking now that their culture, their brand is going to disappear, because they will think that maybe their work is going to disappear as well, and it's not a position in which they can maybe challenge procedures and way of working in Nationwide and come up with a very, very good confrontation and on how to do things together in a better way that is not keeping doing things as Virgin Money or Nationwide, but bringing something stronger. And this way, I'm just afraid that it's going to be more like a takeover, and not much is going to resist of the culture, and probably again user experience, customer first, all that stuff is not just going to be part of the new reality.
So on that note, and maybe Dave, you can talk about this. So could Virgin Money have driven a harder bargain? So back in March, our head of VC, Jamie Campbell, told us that the biggest winner of this deal would be Richard Branson, which you also touched upon yourself. So Branson is expected to net around $650 million on this deal, but some analysts have suggested that Virgin was underpriced. What do we think about that?
Yeah, I kind of get the analyst's view on it, but Virgin haven't been shifting much market share for a long time. So, were they a hot tip to buy from the market? Not really. So, it's, I think they got a really good deal. Branson's done well because he was a massive shareholder, out on this, and he built it from the ground up. There were a lot of areas that aren't overlap in the two businesses. I talked about the business banking. The credit card business on the Virgin Money side is sort of quite separate, and there isn't really a massive overlap on Nationwide. So there are aspects, I suppose, they could keep separated and keep teams that are segregated that do relatively different things. That even possibly keep some of the brand around that in those areas. But, you've got to think if you're in the Virgin mortgage business that, you're going to get swallowed into that side of Nationwide for sure.
So to wrap up this story, who do we think the clear winner is here? Nationwide?
Yeah, I think Nationwide are the winner because I think this is a big win for them from a growth of their business in overnight, pretty much.
Great. And Jess and Alberto, you're nodding. So yes, we're going to say that the real winner here is Nationwide. And I'm going to move us on to our next story, which is that the Justice Department files an antitrust lawsuit against Visa. The story was in the New York Times. So accusing the company of monopolizing the debit card market, the suit claims Visa has suppressed competition by encouraging banks and merchants to exclusively use its payment network, limiting options for processing debit transactions and stifling innovation. This case is part of a broader effort by the Biden administration to target monopolistic practices and reduce fees imposed by corporate middlemen across various industries. Visa currently processes over 60% of US debit transactions, generating more than $7 billion in fees annually. The Justice Department argues that these fees, though paid by merchants, often get passed down to consumers, disproportionately affecting younger and lower-income customers. Visa has dismissed the lawsuit as meritless and plans to defend itself against the claims. So, as our payments expert, Alberto, I would like to come to you first. What do we think are the potential ramifications of this? Does this have merit? Visa says not. What do you think?
Well, this was a very interesting news for me because I've been looking at Visa and MasterCard in Europe mainly, and since the introduction of the cap on the interchange fee, and it looks like the European regulator has been really massively focused on lowering the huge power that Visa and MasterCard have, and 2/3 of European transactions are processed by them. And I realized how much they start to be challenged already also in US. Because in my imagination was like, okay, Europe is fighting the US giants, but actually they have a lot of things going on in US as well. And I remember also the kind of litigation with Amazon in UK. So, I mean, we have to admit that they are actually very, very big, and we are more used to these kind of challenges towards the big tech company of the world. But if you look at the payment space, it's absolutely concentrated. And I mean, if we built Satispay, is because we kept on hearing the merchants complaining about cost, complaining about transparency, complaining about not feeling really treated properly by the networks. And I do believe they have brought a great contribution in digitalizing every economy across the world. But I think now they have been holding more accountable, and I think there is something behind that. Of course, it's probably not going to be as bad as the regulator is saying, but I think I'm kind of surprised that it's coming from the US as well. But it's also gave me more awareness on how I knew that they are much stronger than MasterCard there, but the position is pretty impressive, 60% of the US market. So I'm curious to see what's going to come out of this, but I think it will have competition again.
How realistic do you think it will be to actually break that dominance? Is that, is this a kind of forever thing, or can it be achieved, do you think?
So what we are seeing, and it's more looking at the developing markets, and I wrote an article in the past by saying that we are kind of looking east and south more than west, because fintech services are kind of taking off more in countries that are younger, while US, Europe are kind of older population in general, and where a fintech solution can really improve people's life, from M-Pesa in Africa to Alipay, which are pay in China. And so it's kind of happening later, but in the Western world, where we see local champions growing. So I think that the future of payment can be that we're going to see a lot of local champions rather than 2 or 3 very huge group dominating payment across the globe. And it's not going to be only because of the regulator. And I think the regulator probably need to focus more on creating the right environment for new players to come on the market and compete. So it's probably a lot is going to be in the detail of their agreement with the banks. So these banks kind of forcing their clients, ending up always on the same card issuer. I think that's what needs to be broke to really allow new players to come in and compete, and at the end bring more value to the end customers.
And Dave, what was your thoughts on that? Will we see an increase in competition, innovation? As Alberto is saying, like, is the lawsuit, the regulations not enough? Like, more has to be done in the space more broadly.
Yeah, I think the word meritless was definitely lawyer speak, because this has been coming out, and Regulation 2 came out several years ago, which basically in the US said it's irrelevant who your acquirer is and who your merchant is. You can, it doesn't tie you to the network that is issuing the card on, and the scheme that you're based to, you can go across any network. And when I was working at Discover, we saw, a lot of the acquirers starting to move across the Discover network for debit cards and things like that. But it's such a slow and difficult technical migration for anyone that very little has happened on it. So Visa have had that warning shot. They've been told that those rules have changed and things like that, but they've been very slow to act and to actually make anything change here. I think the reality is, though, debit card usage is dropping in the US still. It goes down month on month. It's still massive. It's still I think as we start to, we'll see more move away from card networks. That's where payments will go, and that's, you're not going to see by what the Biden administration is doing that's going to shift Visa's dominance on that world, because that's where they sit, and they'll control that. I think, if they can push and they can manage the pricing and the costs on that, then that's probably a better way. Either way, it'll probably get killed by, if it isn't a Democrat government in November anyway. But I think the change will come with, peer-to-peer payments that are getting off the card network, and, whether that's through, new startup fintechs coming into that space, the increasing use of FedNow and other things like that, Vimo and other things that starts to see the dominance of the card world from payments start to shrink.
It's just more like the change will come because users' habits change, not because any kind of administration or regulation tells them to.
Yeah.
Jess, what's your thoughts on this? What could be the broader impact on fintech and any other industries, sort of looking at this kind of quote-unquote junk fees and kind of antitrust action? Where do you think we go from here?
I think this is really interesting and is a little bit challenging at the moment. It's a little unsettling seeing this come through. It is good in many ways and will hopefully open some doors in terms of competition. But one of the areas where I think it's really going to push is things like the buy now, pay later space. That's definitely rapidly grown, and we've seen lots of leading players trying to capture up massive parts of the market share. And they're looking at this thinking, okay, are we going to get a similar thing happening here? And then from my perspective, we work quite a bit at the buy now, pay later space. They already have regulatory scrutiny in other areas, like financial crime compliance. And then looking at it as well from this kind of angle in terms of the antitrust area, there are many different concerns where we might see it entering other markets, for example, like the BNPL space. I think it's challenging. We just have to make sure it's not hindering or creating a kind of caution or challenge to innovation, and making sure it is actually having the right impact, which is creating a proper competitive environment.
Absolutely. And Alberto, what do you think the impact of this on Visa will be? So their share price dropped 5.5% after this announcement. Do you think that has like a real world impact? Does that shake investor confidence or change anything on the sort of payments landscape?
Well, I think Visa will be pretty active also in doing other things such as other tactical acquisition. And I think they've been moving away from just being this network of themselves. And I know they always talk about being the network of networks. So I think we've been seeing in the past years a lot of effort from Visa into entering into the open banking world, entering into the fraud world, and kind of start offering services. I think that it will really have a long-term impact if this is kind of opening a bigger reflection on the multilateral scheme model, because probably where innovation will come is more on as model like buy now pay later, this platform, or like ourselves owning directly the relationship with the merchant and not being in this model where too many parts are involved. And that if you think about the fact that there's a network, there's a banking issuing, there's a banking acquiring, or even sometimes someone else in the middle, doesn't look like something that could be designed today, where a single player can online attracting merchants, attracting consumer. And I think what is being a challenge now slightly with this legal case, and probably investor have to look at, is if it's still sustainable to have 99% of your business being distributed by your partner banks, and how valuable can a company be that doesn't really have any direct relationship with the end consumer and the merchants. And about payment method, the decision to choose one or another is always in the end of the consumer. So I think innovation will come from that, from companies that can establish the direct relationship. And I think when that will start growing also in US and Europe, you will maybe see the Visa valuation really starting dropping more consistently. For the moment, I think it's too early. I think we don't see enough competition there yet, and Visa have time to really push another model. But they kind of trapped in the fact that they cannot go straight to the clients. They're not like in the internet world where you play and you own the customer, being Google, being Meta, being Amazon. They're a B2B solution, B2B2C. And the B2B2C in a world dominated by technology, I think over time is going to be weaker. So I'm really interested in understanding how they can play that, because they are stuck. They cannot go around the banks. They are their only partner. They have to respect them. And what they can do is only being the infrastructure, not anymore for payment, but maybe for information, data, fraud, and all of that, and become the infrastructure also of other network and not only Visa network.
And Dave, you were nodding along during that, and we've only got a few seconds left on this story, but just wrap it up for us.
Well, I suppose that, they're never going to fix the fact that whole card payment world is just a digitized form of what was paper a long time ago. It's never changed. That model has always been the same. It's it's all, there's a lot of digital solutions that are coming on. It's the mantra we give at 11FS. This is there's a digital world, and it's a very much a digitized solution that's just sort of systems that manage what was paper for a very long time, and it hasn't changed since when it was paper. It's just electronic version of what it was.
And on that note, we're going to take a quick pause and back shortly.
This episode is brought to you by Atlassian. Atlassian makes the team collaboration software that powers enterprise businesses around the world, including over 80% of the Fortune 500. With Atlassian's AI-powered software like Jira, Confluence, and Loom, you'll have more time to do the work that matters. In fact, Atlassian customers experience a 25% reduction in project duration per year. Unleash the potential of your team at Atlassian.com. Atlassian.
Right now, get scary good deals on select Ring cameras and doorbells. See who's there. Keep your scaredy cats company.
Oh, it's okay, sweetie. I'll be home soon.
And protect your crypt from the real monsters.
Oh, come on. The sign says take one.
Save big on select Ring devices right now at ring.com.
Welcome back. Before we dive into the rest of the show, we wanted to let you know that the shortlist for this year's 11FS Awards is out now. You've had your say, submitted your nominations, and now our panel of experts has put the rubber stamp on the shortlist for this year's 11FS Awards. This shortlist of 49 brands truly represents the best of our industry, those that are pushing for real change across financial services. Head to 11fsawards.com right now to see who made the cut. Back to the news. And our next story is that UK regulator fined Starling Bank £29 million over shockingly lax crime controls. Quote, this was in the Financial Times. The Financial Conduct Authority has fined the UK challenger bank, accusing them of failing to adequately control financial crime. The FCA highlighted Starling's inability to keep pace with its growth in identifying potential money laundering, sanctions breaches, and screening high-risk customers. Despite agreeing with regulators to halt opening new high-risk accounts, Starling proceeded to open 54,000 such accounts between 2021 and 2023. In a statement, the FCA said the bank's senior management as a whole lacked the experience and capability to effectively implement their voluntary agreement around high-risk customers with regulators. Strong words. So, Jess, you are the financial crime expert on the podcast today. What did you make of this when the news broke?
Gosh, what a couple of days it's been. I've been fielding lots and lots of questions on this over the last day or so, but this has been a real shock because Starling has a great reputation. This is the first fine that they have. And some of the things that have come out in the fine are a little shocking and a little challenging to think about. And I kind of break it down into three key failure areas. The first one is not keeping pace with the growth of the business. This is very similar to the Coinbase fine. From a year or so ago, from not very long ago. Ultimately, firms that have rapid growth in customer base and rapid changes in their risk profile need to make sure that their financial crime controls are keeping pace with that. It's not just an implement when you first launch and hope for the best. It's making sure that when you are growing, those are changing. But to do that, you need to have strong governance and management information and reporting processes in place and really strong people to do that. And that leads me on to the second failing, which was the not being able to map their VREC, so meeting their VREC requirements. So this is where a firm has to sign a voluntary requirement notice to agree to some form of restrictions. And in this case, they weren't able to onboard any high or higher risk customers. But because they didn't have the right reporting in place or the right management information, they couldn't track against their VREC and they weren't compliant against it, which is one of the big problems. And then the final big problem out in the entire fine is the sanction screening. And everyone in financial crime knows that if you get your sanctions wrong, this is a problem. And there are a number of gaps here, including only screening against a subset of UK sanctions lists instead of all of them, not screening against OFAC lists when you have exposure to dollar transactions, not screening enough. So these are all common things that I talk to people about all the time, but packaged together, it's a really interesting, challenging read.
I mean, there's a lot of problems that you outlined there, and sort of thanks for taking us through them in detail. How do they get this so wrong?
So for me, it starts with the governance structures. And often when firms launch, they are really focused on building their product, launching, getting the user experience right for customers. I mean, Alberto's nodding. He's probably building a great product. And thinking about the financial crime and compliance framework is something that often happens at the start, but not continuously throughout growth. But to do that, you need to have strong governance and you need to have strong reporting to track against your growth and make sure you are changing and growing. But of course, that takes money and that takes time and that takes buy-in from your key stakeholders and through your strong governance structures.
Absolutely. And Dave, the Starling management has come under heavy fire in this reporting of this fine, saying that they lacked the experience, lacked the capabilities. Is that all you can put it down to? And in fact, is that even true, given, who actually runs Starling Bank?
Yeah, I suppose, I've previously been part of the senior management regime in previous roles, and you spend a lot of time focused on governance and focused on making sure you get these things right, making sure you've got the right data in front of the right people, and a lot of that is a culture of making sure that governance is right. And so I think for me, the big failing and the big concern here from a senior management perspective, and it's going to be reputational for them in a massive way, is that they didn't have the right culture to push that governance from the top down. And that screams from what you're seeing coming out from the FCA, from the people writing up around it. And you've got to think there's got to be some people who are very worried about their roles through this sort of thing. This is a big gap and a big hole that they've had in their business. And you focused on growth, focused on getting to profitability, and focused on the things that you really need to do to make a successful challenger bank work, but neglecting the core banking pieces of getting and controlling who your customers are and the regulatory side of compliance. Yeah, it worries.
It's not something you can afford to get wrong, like literally and also reputationally, right?
Yeah. Yeah, and it must be it can't be just lack of experience, because as you say, you've got people at the top of Starling. We're going back now, not it's different people, but then in 2021 it's people who have been in the banking world forever, for their entire careers. They know and being senior people, they know how this stuff works and things. And so it has to be a culture facing the wrong way and looking at the wrong metrics from the bank's perspective, and thinking about what was important for them as from a growth perspective, but not from a what the regulator cares about, which it's going to hurt them.
Alberto, as a founder yourself, what was your kind of reaction to this story, and what do you think the impact might be on Starling from here on?
I was very, very surprised by the tone of what came out of the FCA. And yeah, I'm surprised. I don't want to talk really about any other fintech, any other founders, but what I started thinking is FCA is a great regulator, but is also very focused on looking at companies where they are big enough that matter, and maybe probably letting them experiment more in the early stage of their life, which is the reason why most of the great fintech in Europe have been founded there. And we also had a regulated institution in UK before Brexit that we had to move in continental Europe. But startups, I think the great definition of startup is being given by Reid Hoffman, the founder of LinkedIn, that you're jumping off a cliff with the pistol to build an airplane, and you have to build the airplane before you crash on the ground. This is what we feel as founders. And when you have to care about compliance as well, I think you have to be passionate about that. You have to see in that as an opportunity to build a better business, to have lower fraud, to have lower risk, to have at the end a better balance sheet. Otherwise, the risk is just to be focused on growth, and think that's not part of it, and leave it to someone else. And if this do not come to the board level, that is kind of dangerous, and it's a tough balance. And I don't think it's enough to have people that have been in the corporate banking world, because I think the industry have to create more talent into the product compliant work. Because building a challenger bank that creates a space and become relevant, a new bank is so complicated. You really have to come up with great products, and you have to let your product manager and engineering come up with new things all the time. can they talk with the compliance people? Can they understand each other? Can they really figure out all the consequent steps that they need to take to create the right reporting? If you have like corporate people that have never been talking with an internal tech department, building new product, I think that's almost impossible. And I'm just shocked and a bit frustrated about the tone of the FCA declaration, because it looks like now fintech are becoming real, are becoming mature, and I hope we don't hear too many of these news, because of course their reputation is damaged. But the problem is when the fintech reputation generally is damaged, and I think great scale up. If they can balance very well compliance and product, they can build better bank that have better control, that are more compliant, and that are more user friendly. So I'm still trying to understand what really happened. No one knows yet, but I feel sorry, because I think fintech needs a credibility more than ever before, now that we are proving we move billions and we are sustainable businesses.
Yeah, no, that's a fair point. You don't want a headline that negatively affects the whole industry just for one sort of potentially not isolated, but in this case, like isolated case of one brand being fined. And Jess, I wanted to come to you on the fine itself and the kind of FCA methodologies here. So it's kind of reported that they would have been fined more, but they agreed to resolve the matter and got basically a discount on their fine. And equally, there's also a report that the FCA itself took less time than they normally would to kind of process these things. What impact does that have? What does that mean in context here? Do you get kind of let off for good behavior? Like, what does that mean in terms of their fine being reduced?
In short, yes. So the things that you have to do if you are ever in this situation, which hopefully no one is, but you have to demonstrate that you are remediating proactively and you are fully engaged with the process. And the more that you can demonstrate any remediation against the exact points or fines or issues that they've picked out, the less the fine will be. I mean, in this case, they've already done years of remediation. This has been a long process, and you can read that throughout the fine, that they have been updating their processes. They've been really looking at their tooling. Granted, it took them longer, and they weren't able to comply with their VREC for a long time, but going through the process, demonstrating that you're engaging with the regulator and that you are working with them they will take that into account when they're looking at the size of the fine. And I think that's really, really important. And every time I'm dealing with a firm, and I'm dealing with quite a few of these right now who are going through different skilled person reviews or are dealing with remediations or issues. And the biggest thing that I always advise is build the right story. And your story has to be that you're engaging and you're proactive and you're remediating.
And Dave, final word from you on this. What happens now, do you think? Does the regulator just keep a closer eye on Starling going forward? Because these are sort of historic misdemeanors, for want of another word. But like in 2024, where do they go from here?
They will keep an eye for sure. But, once you've done it once, they will, they follow through on these things. They make sure they're remediated. But I think one of the interesting things, and the bit going back to Alberto's piece around the fintech space, is what does it mean to Starling Engine from that sort of technology perspective? If you were a fintech wanting to leverage that, would you be worried now? And is it a more of a reputational bit for people who want to build on their technology from Starling's perspective, using their BaaS capability? We saw all of the sort of historic issues with BaaS in the US failing through compliance controls on KYC and things that happened there. And are people going to want to actually look at a platform that's got a brand associated that has this behind them as well, that underpins their business? I don't know. It'll be interesting. I think the reputational bit is far, far bigger than £29 million worth of fine. That's going to hurt for a much longer time for Starling to come back from this.
Oh, we shall see. Obviously, the story only broke yesterday, so we will be keeping an eye on it and kind of bringing any updates as we know them. But we're going to move on to our last story for today, which is that Trinidad and Tobago are to roll out India's UPI payments tech. And this story was in Finextra. UPI, which has been widely successful in India, allows for instant real-time payments between banks through mobile phones, simplifying digital transactions for both consumers and businesses. The implementation of UPI technology is expected to drive greater financial inclusion across the Caribbean nation by bringing more people into the digital economy, particularly those who have been underserved by traditional banking systems. UPI's success in India has been largely attributed to its ease of use and ability to facilitate low-cost transactions, which has made digital payments accessible to millions. The MPCI international subsidiary was set up in 2020 to push the UPI as well as the RuPay card network outside of India. And already this year, the unit has struck deals with Peru, Namibia, and Nepal's largest payment network, and it has also joined forces with Google Pay to accelerate global expansion. So there's a lot to unpick here, but Alberto, maybe coming to you first. How do we think the introduction of UPI technology can help bridge financial inclusion in Trinidad and Tobago? How does a payments network do that?
Well, I think it kind of also ties to what we were saying before about Visa, which requires such an infrastructure and a banking industry to distribute that, while something like UPI can be much weaker in bringing every level of consumer on board, even unbanked population, and it's been tremendously successful in India. I think it was already happening with a market player like Paytm, and then the regulator came in and the government came in. I don't know how much this can be replicated across the world. I don't know if Europe, US, they can have a national initiative and build something like this, but for sure this ties to creating alternative network that are more suited to the specific needs or of certain countries, more than a couple of US card networks. And I think that alongside Pix in Brazil, that is starting to be also expanded in Argentina, and also we are dealing with a lot of firms from Brazil that wants to integrate our QR code, so then tourists coming to Italy and Europe can still pay with Pix also over here. I think this also going cross-border is kind of the indication that maybe we are going towards a world where local solution can better serve the local needs, and then the interoperability between local solution can be a true alternative to the card networks. It's right that Trinidad and Tobago, with 1.5 million inhabitants, joins something bigger like UPI. I think it's the right move, and I think based on the success of the adoption, we will understand if we're gonna see alternative payment method becoming the norm, and not only the exception in China, India, Korea, and some other markets.
Yeah, that's a good point. And also, we've got a stat here that says that Trinidad and Tobago had a 130% mobile phone connection rate in 2023. And this is rising. I don't actually know how you can get over 100%. But either way, the kind of mobile payment and mobile first design of UPI is probably part of its attraction, right?
Yeah, for sure. I think the 130% is more than one handset per person totally.
Got you. Okay.
I think UPI works really well in that in countries where there are a lot of sort of unbanked people and things, and I think Trinidad will be other. I think it's a good move. I think for UPI going to Trinidad and Tobago, I think there will be other opportunities across different Caribbean nations to take that route there. I can't see UPI coming into sort of Western Europe in the same way, or the US in the same way, because of just the depth of banking in the populations, and it'll be a very difficult move for them. We have started to see them hooking into cross-border out to UPI from various parts of Europe and things. If there's a UPI bridge out of France, for example, and things like that, but I don't think they'll be deploying into those areas in the same way. But this where they've started, there's a lot more countries they can cover around that covers it, and UPI is a good solution. It works really well. It's both peer-to-peer and merchant to consumer, and so it's a very powerful solution. They've got, if you can make it work in India, you can make it work anywhere in these smaller countries. They've got such a huge population using it in India that I think they'll succeed in getting it much broader than they have already in these few countries.
And do you think their kind of opportunity space and the space that they play in most is those kind of like developing banking systems that maybe don't have the kind of historic legacy systems? We've sort of already said they've already done things in Peru, Namibia, Nepal. Is it the kind of similar economies to those is where they're going to win?
Yeah, I think so, and we'll see it continue in that. But then once you've got that base in there, you can start to offer other products and other services into those customers, and really grow across from those areas.
Definitely. And then there's obviously the cross-border piece and the interoperability that Alberto was mentioning as well. So it's not just serving that market in that market, it's serving that market so it can also work with others. Jess, what's your thoughts on this? Do you think there's any blockers to this from that interoperability piece or a regulatory angle, or is this all a good thing?
It's all great for customer experience, but anything that's instant real time from a financial crime perspective is a challenge, because it really depends on instant monitoring and having really, really effective monitoring capabilities. Alberto's point on, these operating in sort of local regions, there are very specific local nuances that you can pick up on when you're developing monitoring capabilities. But when you start to have cross-border, it makes the whole thing even more difficult to monitor from a financial crime perspective. And it also opens it up to being used in more ways by criminal actors, instant cross-border. It's what we don't want to hear, but we know we need to get there. So ultimately, from my perspective, it really does. You need to make sure that the controls are very, very clear, and it's mainly down to monitoring and very, very sharp, fast monitoring, but also having the space to investigate where you need to. But in real time, that's very hard.
Yeah, I think it's probably important to be clear that the countries that they've rolled out do not interoperate. They use the same technology. It is a network for each of those countries. So there isn't instant cross-border in there across between those different regions. They work within their own. They're all independent. They're their own currencies on each of them. I think there is always a push. Everyone wants to make cross-border work, but it's never going to be simple. It's never straightforward. No. And that's where all the big financial crime view is looked at from any perspective and any regulator.
If I can jump in on this, because I don't want it to be underestimated. In this context of the world, unfortunately, where geopolitical matter a lot, I think we shouldn't underestimate how powerful it is for India to spread its infrastructure and technology in other jurisdictions. And I think this is a great way to plant a seed. And eventually, can you imagine they're adopting UPI and everybody paying with that as it happens in India? That they will depend from an Indian infrastructure. And I think this shouldn't be underestimated. And I think Brazil with Pix is kind of trying to do the same. And one of the reasons why we'll not see it playing in the same way in Europe and US, it will probably be the reason to launch a digital euro, a central bank digital currency, because it's a matter of sovereignty. And maybe I'm not surprised about some small place like Trinidad and Tobago, but if they can get the technology and infrastructure in bigger markets, or maybe in Africa as well, it's a kind of way to conquer a new territory and being the infrastructure that serves everyday transaction, and eventually on top of that provide other additional services. So I think we need to keep an eye on that from a geopolitical perspective and don't underestimate these things when they start happening for real.
Absolutely. Well said. And we will obviously keep an eye on this one as well. And, we wish them every success, and we'll and just hope that they have all the right things in place to satisfy Jess on the financial crime side as well. Okay, now for a quick look at a couple of more click-worthy news stories this week that we don't have time to cover in full. And the first is that Klarna partners with Adyen for in-store buy now, pay later rollout. This from Fintech magazine. This move will integrate Klarna's flexible payment options into Adyen's in-store payment terminals across Europe, North America, and Australia. By rolling out Klarna's BNPL options on more than 450,000 Adyen terminals, this partnership signals a shift in the buy now, pay later market from being predominantly online to also catering to brick-and-mortar retail. This collaboration highlights a growing trend of integrating digital payment technologies into physical retail as both fintechs and traditional financial institutions race to capture a larger share of in-store transactions. Dave, what was your thoughts on this?
I think this is a really interesting change from Klarna's perspective. Getting to bricks and mortar, I think, is a key move for them. I think it will help them in their push to try and get into North America more. But bricks and mortar, being able to actually get to a buy now, pay later solution very quickly at the terminal in the store, I think is a big, big win for them. And, all of these things that they're doing, obviously, in their push as they head towards their IPO is going to help them on where their valuations are. But actually, this is huge for them, and I think it's going to make a really big, big shift for some of the things that they're doing. And our second story is from FinTech Futures. So Chime taps Morgan Stanley to handle the IPO in 2025. This is from FinTech Futures. It's IPO rumor season. According to reports, San Francisco-based Chime is preparing for an initial public offer in 2025, with Morgan Stanley set to lead the process. Chime, which has gained popularity by providing bank-like services without the fees associated with traditional banks, is said to want to leverage its IPO to fuel further growth. The company's last valuation in 2021 reached $25 billion, reflecting the fintech's funding boom at that time. However, the current market presents a very different landscape, with higher interest rates and investor caution surrounding tech IPOs. Laura, what's your thoughts on this?
So, as the story says, it's IPO rumor season, which is, very exciting for us, making FinTech Insider. I think if every IPO that's been rumored to happen in 2025 actually does, we will be very busy on this show. I think, obviously, if they've already kind of got Morgan Stanley in on the process, it looks very, very likely to happen. So that's very exciting. But yeah, there's obviously a few more in the mix. We just touched upon them, Klarna in the last story, among others. So I think that, there's the rumor mill is definitely flying for IPOs. I think it's interesting that their last valuation was in 2021 in the middle of that kind of funding boom. So can they expect the same in the current market? I suspect probably not, but obviously time will tell, and equally time will tell whether they're one of those IPOs that absolutely flies and does really, really well, or perhaps doesn't. And there's been quite a few cautionary tales on those over the years. But of course, we wish them well, and we will definitely be keeping an eye on this one to bring you all up to date on FinTech Insider as these IPOs start to drop in 2025. It's going to be exciting. Okay, and now we're going to move on to our And Finally section. For this week's And Finally section, where we usually look at something a little bit different in the world of financial services, we're going to do something a little bit different again to that. So it is World Mental Health Day this week. Thursday, the 10th of October, marks World Mental Health Day, which encourages everyone around the globe to come together to discuss their mental health. This year's theme is all about promoting positive mental health in the workplace. And given that we're a podcast based around what we do for work, we thought we should spotlight some of the things people can do to improve their mental health at work. So, my lovely panel, I'm going to ask each of you for one piece of advice you can give to people to improve their mental health at work. Starting with you, Dave.
It's been interesting few years as you've shifted more to working from home, and I always, I spent many years commuting up and down from London, and I always had the train as my break to shift my brain from work time to home time. And when you're working at home and you walk down the stairs from your little office in the corner of the house, you don't have that breaks, and I think that's hurt a lot of people. from that perspective, find it very difficult to switch off. The piece of advice I give to a lot of people is take the break at the end, have a little wander outside, get away from things to actually give you that separation between work and family time. Because it's very easy when you're just, your commute is a set of stairs, is not enough time to turn your brain off from work to think in a different way.
Yeah, I totally feel that. My desk is in my kitchen, so it's a matter of steps to go from your last meeting to cooking dinner, and you kind of don't always get the kind of brain break you need to go from one context to another. Alberto, as a founder and CEO, we imagine that your work life can potentially get a little bit stressful sometimes. What kind of techniques would you use to manage that?
Once I did an exercise that have helped me a lot, and I have 2 little kids, and my life was kind of took by storm when I had to manage the family and the company, and designing the wheel of life. So creating a wheel and putting family, work, culture, sport, friends, and kind of give a vote. And at a certain point, they were quite low, all of them. But I understood it was all tied to some of my weaknesses of sometimes not kind of postponing things and not jumping onto the problems directly. And so I started playing with my weakness and try to create every day an exercise to push me to sort things out faster, to be on time, to create my agenda in a way so that I can be always prepared for the next meeting, for when I come back home, my mind to be there. And it becomes kind of a gamification, a challenge, and you feel you can tick a lot of boxes, and I think probably create a little bit of a check, giving some marks of where you are with the really important things in your life, understand your weakness, and try to build the exercises and making it kind of fun, gaming and playing with yourself, so that every week you can feel that you have done something even very, very small in a better way. And from a company perspective, bring the executive team together, let's challenge each other, give direct feedback, create the psychological safety to challenge the leaders, so that we have the chance to look at our weakness, to look at the fact that maybe we don't create the right comfort for everyone within the organization. I think that's super powerful, because it's very difficult to create the environment where everybody can give feedback. But if you can do that, it's a relief.
Amazing. Two very different pieces of advice there, but both really, really effective. And I like the kind of continual self-evaluation, but also gamifying it for yourself is a really effective way to do it. Jess, how about you? I imagine, financial crime can be a bit heavy sometimes. So what can you do to kind of alleviate that for yourself?
So I've got 2 things, which is perhaps a nice combination of both of the things that have already been described. But the first one, so I am so passionate about creating a positive culture for my division. So in the financial crime division, we are positive, bring your best self to work and just help each other. And if someone is down, somebody else is always there to ask, are you okay? And do you need help? It's so simple, but just leading by example and creating that kind of sharing, learning, positive culture has been really, really helpful. And then the second thing, very similarly, I just love to go for a walk. I've got a great dog and I just get out and I go for a walk. I always have done. I'm a big hiker. Whether or not it be a short walk or a long walk, just go for a walk.
100%. It does really make a difference. Sometimes you think you're going to perform better by sitting at your desk and just cracking on with things, and it can be hard to tear yourself away. But when you do, it does really make all the difference to kind of just get some fresh air, get a sort of blood moving a bit more than if you're just sort of sitting down, and it does kind of give you a fresh perspective. So I would definitely second that. And completely that kind of culture of transparency is super important. And I think also coupled with that is, and obviously it depends on the kind of comfort levels that you have in the company that you're in, but also trying the best you can to kind of bring your authentic self to work and being supported in that, because it can just be exhausting if you're like playing a role or not being your true self the whole time. I think allowing yourself to be the best version of yourself and to be the real version of yourself around your colleagues, around your peers, and even, senior leaders or your direct reports or anything like that, I think that's just really refreshing and can be good for you. So that, as you say, Jess, like if you are having a down day, it's totally fine to say so, and people will respect that or help you or jump in or do whatever, or maybe you don't want them to do anything at all, you just want them to know, and I think that's that's a really, really nice culture to have that can make all the difference. And here at 11FS, we've created a bunch of resources, including podcasts and articles on the relationship between mental health and work, as well as the impact money has on our mental health. We'll put some links in the podcast description below, so please head there or visit our content hub over at 11fs.com to find out more. Just type in mental health and a whole bunch of content will pop up. And I've produced some of it over the years and worked with some amazing people with some fantastic suggestions to what you can do if it's all getting a bit heavy on the kind of link between money and mental health is so strong. So definitely check that out. And on that note, that wraps up this week's FinTech Insider News. Thank you so much to today's guests. Where can people find out a little bit more about you and your companies? Maybe let's start with you again, Dave.
Yep. You can find out about me on LinkedIn and all of the various bits of content at 11fs.com.
Fantastic. Alberto?
Obviously, Satispay.com, and on LinkedIn, I'm quite vocal, so you can find a lot there. Or maybe also Crunchbase. We raised a bunch of money, so there are quite news on that as well. But LinkedIn is probably the main source for international readers.
Brilliant. Thank you. Jess?
Yeah, it's Jessica Cath on LinkedIn and also the Thistle Initiative's website.
Fantastic. As for me, Laura Watkins on LinkedIn or otherwise 11fs.com, or of course FinTech Insider, which hopefully you're already subscribed to. So thank you for listening. If you like what you've heard, please follow our podcast and don't forget to leave us a review. It helps us make a better show and helps other people to find us. If you're listening on Spotify, you can now drop us a comment and tell us what you thought of the show. And as always, if you want to join the conversation, find us on social media. Just search for 11FS or FinTech Insider or email podcasts at 11fs.com. And we also now have a brand new WhatsApp community channel where you can get the inside track on all of our content. You can get involved via the link in the description below. Thanks very much and goodbye.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.